If you are a homeowner, it's likely that you have what we call in the real estate world untapped equity, and we're going to talk about that today. My name is Moriah Taliaferro. I'm a realtor with Premier Sotheby's International Realty, specializing in downtown Sarasota and the surrounding Keys. And I am here with Jose Moreno, who is a banker with Synovus Bank here in the Sarasota St. Pete area. He is an expert on mortgages. And we're going to talk about home equity line of credits and untapped equity that you might have in your property. So Jose, let's just first define to our viewers, what is untapped equity?
Well, basically, untapped equity is equity that you haven't touched.
Mm-hmm.
So you have a property that is worth $500,000, and then you owe $300,000 on the property. So you technically have $200,000 worth of equity.
Mm-hmm.
How is that equity being used? Well, the equity can be used or can be tapped into in the form of a home equity loan. Which is a very inexpensive way to access your equity. And the reason behind that is because the payment is calculated on an interest-only basis versus a principal and interest basis. And the closing costs are lower and sometimes free compared to a regular traditional mortgage. So just to give you an example, I mean, just so that you can see that basically the payment difference when it's being done on an interest-only calculation is not that much of a difference in regards to the rate that is being calculated. So, for example, today's rate, and the one thing that I want to educate the public is that anytime that the rates go up, when the Fed say the rates just went up by 1/4 of a point or they went up by 1%, the home equity loans directly get impacted by the same amount of money, by the same amount of percentage that the Fed had increased the rate.
Okay.
So today,
versus a traditional mortgage.
A traditional mortgage is, I mean, it will be impacted, but it won't be by 1/4 of a point or by 1%. It's something that has already been calculated before the Feds even go out on TV and say that they already.
And let's just stop right there and explain that a little bit more. So the Fed increases the rate, 0.25%. That doesn't necessarily mean that a traditional conventional loan is going to increase the rate by 0.25%.
Correct. It does not.
And why is that?
Because technically, the Wall Street, they already assume that the rate is going to be increased before the Feds do it. And it is tied up to the 10-year Treasury bill, which is not the prime rate that is impacted directly by the Fed. So it does not mean that it's not going to go up. It goes up before, or a month before, or a week before than the Fed announces it, but it doesn't go up by the same amount that it goes up directly on prime.
And am I correct by saying that when the Fed raises rates, that's essentially raising the rate that it costs the bank to borrow that money? And so they may be cutting into their profits, for instance, to not make it go up that full 0.25%, or?
No, the bank will increase the rate. The bank will increase prime, and prime is an index that banks use to basically determine what the interest rate is going to be, in this case, in home equity loans, on credit cards, on commercial loans, and so forth.
Okay.
So if the Feds increase the rate by 1%, then prime goes up by 1%.
Okay.
And the way that the banks decide or determine what the interest rate is going to be in a commercial loan or on a home equity loan is going to be prime and prime plus. That prime plus, it can be prime plus 1, it can be prime plus 2, it can be prime plus 0, or it can be prime minus 1. It all depends on what kind of loan product is the bank going to be offering, and also the criteria is also going to be determining the rate by the credit scores of the customer, the loan to value, and so forth. Sometimes they have an introductory rate, regardless of what the prime rate is, of say 2% or 3%. And then 6 months later, it gets tied up to prime plus 1, depending on the offer that the customer accepts. But the one thing that I want to indicate is that a home equity loan is a very wise tool that you can use if you're shopping for a house. If you want to buy a house and you haven't sold your house yet, you can always, or you are going to keep your house, you can always tap into your equity in the form of a home equity loan, take the money out and use that money for the down payment of the new property that you want to buy. If that happens to be an option that is going to be favorable, if you're not going to be selling your house, or if you're going to be waiting on selling your house, or if you can afford both houses at the same time, which a lot of people can, or if your current house is going to become a rental, then you have options to tap that equity and use that money for the down payment while the equity is there. You know,
now you can also use that equity to do any renovations
Oh,
to the
absolutely.
home too, right? There's no limitations to what you can use that money
you
for.
can use that
It's a
money
line
for
of
whatever,
credit.
for whatever you want. So let's just have an example. You got a property that is worth, just like the one that we were talking about before, $625,000. That property is, has a mortgage of $400,000. Typically, home equity loans will go up to 90%. Some of them will go up to 95% of the value. So basically, 90% of the appraised value of $625,000 is $562,000. Well, actually, $562,500.
To be exact.
And then you subtract the first mortgage balance, which is $400,000.
Okay.
So the available equity to borrow is $162,500.
Okay.
So you have a line of credit. You're only going to have a payment, an interest-only payment on the amount that you draw.
Okay.
So a line of credit is kind of like a credit card. And so say you get it approved, you close it, and then you take $50,000 out. So when you take $50,000 out, your payment on a line of credit at today's rate, which is prime plus 1, is going to be 7.25. Your interest-only payment is going to be on $50,000. Is going to be $302 a month.
Okay.
They used to be at 4.25, which was $177 a month.
Okay.
So the difference on the payment, I mean, it's 100 and change.
Okay.
But again, usually they're short term.
Right.
And again, you can pull out $50,000. You can pull $100,000. Have that balance for 6 months. It's not going to kill your standard of living by having this kind of payment.
Sure.
But again, they're usually temporary. I advise customers to only get them for emergencies, for something that they're going to be using.
Or for an improvement on their home or something
Correct.
like that.
Because
they're gonna pay
you
out.
got an adjustable rate. This rate will change every month or every time the Fed increases the rate.
Okay.
So that is basically the main difference between a traditional fixed mortgage and a home equity loan. So yes, we are offering them, and we do have options, even without closing costs. We have a very good product on our home equity loan division at the bank. So this is something that I recommend for customers to look into, and a lot of customers are aware of it. And it's a very good way to, if you can qualify for the new house that you're going to be buying, and also keep this house, it's a good way, it's a good tool to use for the down payment of the new house that you're going to be purchasing.
Thank you so much, Jose. This has been so helpful. What great information all about home equity line of credits. And if you have questions specifically about HELOCs and you want to look into your situation and what you can afford, then please contact Jose directly. His information is below. And we're here to be of help if you ever have questions about real estate. Thanks so much for tuning in.